Let's now talk about audit procedures. Now, if you have been religiously following our lecture series, then you would feel some sense of deja vu and you might feel like, hey, wait, this is familiar. And this will particularly take you back to the second installment that we had when we gave the overview of the FS audit process. We did talk about audit procedures also there, but for this particular segment, we're going to enflesh those concepts a bit more. Because I hope you're ready. You already know that when we talk about scope of an audit, it mainly just refers to the audit procedures deemed necessary in the circumstances to achieve the objective of an audit. And early on, we made mention that when we talk about the scope of an audit, actually the auditor has the chance to choose, the chance and the freedom to choose any and all procedures that the auditor determines is necessary for the auditor to give an opinion. We mentioned that the auditor can do observation, the auditor can talk to people, the auditor can interview, the auditor can observe physical counts, the auditor can, pursue or conduct a cash count. All of these things are available to the auditor. These arsenal of procedures are available to the auditor, which will later on allow the auditor to give a positive conclusion and a reasonable assurance. Now, speaking of audit procedures, since scope of an audit refers to audit procedures are the methods or acts that the auditors use to gather evidence. So, the very purpose of audit procedures is for the auditor to gather evidence. And we gather evidence to determine the validity of the FS assertions. We go back to the storyteller and the story and evaluating the story. In the course of evaluating the story, we need to gather evidence. And to gather evidence, we need to perform audit procedures. So if you can picture it out in your mind right now, well, it starts with the assertions. From the assertions, we come up with objectives, and the objectives will lead us to the procedures that we will be performing. Let's now look at the audit procedures according to purpose. And this is the part where you will feel a strong sense of deja vu. These are the audit procedures according to purpose. We already know that we have risk assessment procedures or RAP, and then we have FAP or further audit procedures, which is further comprised of test of controls and substantive procedures. When we talked about preliminary engagement activities, audit planning, materiality, risk assessment and even internal controls, risk assessment procedures really took the center stage. And we said risk assessment procedures are procedures used to obtain an understanding of the entity and its environment, including its internal controls, to assess the risks of material misstatement at the FS and assertion levels. We also recall that in the 2019 revision of PSA 315, there has become lesser of a focus on obtaining the understanding, although of course it's important, it's a crucial part, and more weight is then given to risk assessment. So risk assessment procedures are intended to assess the risks of material misstatement, and we said this is where the GTKY, getting to know you, would come in, and the auditor will get to assess both inherent and control risk of the client. And we also made mention that under risk assessment procedures, we basically perform the big three IIO: inquire, inspect, observe, and of course, included to that is analytical procedures if performed in the planning phase. In the third installment, we also made mention that if you want to take a look at the design and implementation of the control, in your aim of assessing control risk, you look at design and implementation under risk assessment procedures. We also mentioned that for the implementation part, you could perform a walkthrough test. Now let's now take a look at test of controls, and we know that test of controls test the operating effectiveness of the controls in preventing, detecting, and correcting material misstatements at the assertion level. We then made in the last installment a very clear distinction that when the auditor considers internal controls, the auditor considers it at the risk assessment phase by performing RAP, looking into design and implementation. And if certain conditions are met, where, such as when you intend to rely on the controls, or in the case of RSPAs, risks for which substantive procedures alone cannot provide sufficient and appropriate evidence. It's all found in our third installment when we talked about internal controls. You may want to pay that a visit if you need to, review these concepts. If those conditions are met, then we perform test of controls. Otherwise, then we don't need to. If you don't intend to rely on the controls, you don't need to test the controls. Lastly, of course, we have substantive procedures. And substantive procedures are there to detect material misstatements at the assertion level. That's why they are called test of assertions. We have also highlighted the importance of substantive procedures because at the end of the day, our objective is to give an opinion on whether the financial statements are free from material misstatements. And it would be substantive procedures that would detect those material misstatements. We also remind ourselves that of the three audit procedures categorized as to purpose, risk assessment procedures are required to be performed more so since we are using the risk based audit approach, and substantive procedures are also required to be performed as what we have mentioned, they are the ones that actually detect the misstatements. Okay, now putting our focus now on substantive tests, there are two general categories. We can call them substantive test of details, and these substantive tests of details could either be details of transactions or details of balances. So when we mention substantive tests of details, this will involve obtaining evidential matter on the items or details involved in an account balance or class of transactions. So as mentioned, they can be referred to as tests of transactions or test of balances. For this, I'd like you to picture in your mind, draw in your mind a T account. Have you already drawn it? You still remember the T account? Very useful tool for us, right? So imagine the T account and imagine there are entries to the debit and credit side of the T account. Then we know from those entries and of course the beginning balance, we come up with the ending balance, right? So if you want to test the assertions, if what you want to do is to perform substantive test of sorry if you want to test the transactions, if what you want to do is a substantive test of transactions, then you will be testing the debits and the credits. Okay, that's a test of transactions. You test the processing of the individual transactions, normally by inspection of documents and accounting records involved in processing. Test of transactions is test of debits and credits. But if you want to perform substantive tests of balances, then you test the ending balance. Take note, the ending balance, not the beginning balance, because the beginning balance has already been tested as the ending balance of the prior year. So when we say test of balances, it's test of ending balances. So if you can imagine, for example, accounts receivable, if you want to test the balance of accounts receivable, then you would normally do this one by performing confirmation and sending a confirmation letter or a confirmation request to, say, the customer of your client, and asking the customer of the client to confirm if they truly have a payable to the client amounting to, let's say, 10,000 pesos as of a certain date. That's a test of balance. Now we know that an accounts receivable balance is affected or made up by sales and then reduced by collections. But if we test the balance, what we are interested in is the ending balance. So when we give the confirmation request, we ask the customer to confirm the balance, meaning the unpaid amount. Okay. But if we are testing for transactions, we will test the debits and credits. So imagine the T account for accounts receivable. What would go into the debit side of an accounts receivable? We will debit the accounts receivable every time there is a credit sale, right? We debit AR and then credit sales. And we will credit accounts receivable whenever there is a collection. We will debit cash and credit accounts receivable. So in this case, if you are testing the transactions, then you will be testing credit sales and collections in relation to accounts receivable, of course. So that is the difference between test of transactions and test of balances. Okay, now the other category of substantive tests is what we call substantive analytical procedures, or SAP, or in this case, analytical review procedures. This would involve a study and comparison of relationships among accounting data and related information. We are working on the context that there are predictable relationships in the accounts, and that we should be able to identify unusual fluctuations. And when we identify these unusual fluctuations that breach a certain threshold, then we would, of course, have to investigate and focus on the rationale of these unusual relationships or fluctuations. We will discuss substantive analytical procedures in a bit more detail a few slides from now. Okay, but again, the general categories would be test of details and analytical procedures. We are also reminded that between the two, it would be test of details that would be required to be performed as substantive analytical procedures are optional. Okay. Now, I know that you already know the difference between tests of controls and substantive tests, whereby we say if the test of controls would reveal that the internal controls are reliable, then we will perform less substantive tests. But what I would like for you to reflect on right now is the fact that test of controls only provide evidence that a misstatement is likely to occur. Okay, likely to occur, meaning to say tests of controls show you the red flags. Tests of controls show you the likely, okay, that there is a likely misstatement that could occur. It does not give you direct evidence about the actual misstatement. And we know this to be true because in our discussion on internal controls, we said not all deviations would result to a misstatement. Remember our example on how one of the control activities would always be the wearing of an ID when you enter a workplace or your school. The wearing of the ID would ensure that only enrolled students get to enter the campus. But then we must have reflected that, well, we have tried at least once. Of entering the campus without wearing an ID, we are a deviation because we did not wear the ID. But were we a misstatement? The answer is not necessarily. We could have been officially enrolled, but we just left our IDs at home. Therefore, a controlled deviation does not necessarily equate to a misstatement. Okay, it will be the substantive tests that will provide the existence, or that will provide rather evidence about the actual existence of the misstatement. This is the reason why between the two, substantive tests are the required procedures and not test of controls. All right, so I hope you were able to reflect on that. Let's now look at the different audit procedures according to nature. If we look at PSA 500, there are actually seven listed audit procedures according to nature, but we're expanding it a little bit here just to give more context. So we have, of course, what is called inspection or examination of documents. This would include examining records, documents, or even tangible assets. So in PSA 500, inspection refers to both inspection of documents and physical examination of assets. Of course, we know that there is a difference in the way we perform these two in a way that if we talk about inspection, what you will be looking at are records or documents. And notice that the record or the document by themselves do not have any inherent value. What do I mean by this? If you are holding a sales invoice and the sales invoice has reflected there that it was for a sale amounting to 1 million, the invoice itself, the paper, the document is not worth 1 million, right? It's not worth 1 million. You cannot sell the invoice for 1 million. Okay, you cannot bring it to the pawn shop and have it pawned for a million. The document itself is paper and it does not hold any inherent value. So when you're inspecting something with no inherent value, you're inspecting a document, you're inspecting a record. So we call that inspection of documents. But when you inspect a tangible asset, say for example, when you inspect a new school bus, the new school bus has value, right? You can sell the new school bus, you can pawn the new school bus. So when you are physically inspecting or physically examining a tangible asset, you are inspecting something with inherent value. So again, we can call it inspection of documents, physical examination of assets, but in PSA or ISA 500, they are both referred to as inspection. The other one is observation, and I'm sure you have done observation so many times in your life. So, observation would consist of looking at a process or procedure being performed by others. Observation is widely used and it's very useful, but it also has its strengths and its weaknesses, just like any other audit procedure. But if we reflect, one of the strengths of observation is that you could readily use this one when there is an absence of an audit trail, when there is no trail of documentation, so therefore you cannot inspect any document, then you can perform observation. However, the weakness to observation is that, well, we all know that people tend to act differently if they know they are being observed. And this is what we call the Hawthorne effect. So we know also that our observation, whatever the results of our observation, will only be true for that specific point in time. We do not know if the moment we have stopped our observation or have left the place, if people started acting differently or in their more natural state, right? So that is, of course, a weakness of observation. Nonetheless, observation is still another procedure that is widely used. And then there's what we call inquiry. When we say inquiry, we simply seek information of knowledgeable persons. But if you want to level up that inquiry into a more formal structure, then what you are actually doing is a form of confirmation. Confirmation consists of a response to an inquiry to corroborate information contained in the accounting records. And this response is in the form of a written response. So that's why it's called confirmation. So inquiry is when we ask, whereas confirmation is when we request for a written response, okay, to a particular information that we wish to corroborate. So confirmation is a more formal structure of inquiry. And then we have what is called computation or reperformance. When we say recomputation, sometimes we call this one recalculation, we check the mathematical accuracy of the source document, okay, and accounting records. But when we talk about reperformance, reperformance is repeating a client activity, normally repeating a client's internal control activity. Okay, so recomputation or recalculation will be, of course, more in the figures, so more related to a substantive test. But reperformance would be to reperform a control or reperforming a control activity. So this will be a test of control. And then we have also talked about tracing and vouching, but we will review these concepts again here. So tracing would involve establishing completeness of the transactions by following from through the accounting records. So our direction of the testing here is from documents to records. If you're still a little bit confused about this, just hang in there. We will resurrect our discussion for tracing versus vouching in the next slide. Okay, and then of course when we talk about vouching, it's the opposite. Tracing and vouching actually test opposite assertions, right? Vouching tests for existence. It involves following a transaction back to the supporting documents, or we sometimes even call this one tracing back. Now, while we are familiar, we endeavor to be familiar with the technical terms, we also need to recognize that in literature and in the questions that are asked in the licensure examinations, it is very possible for the examiner to use tracing and vouching interchangeably. So please make sure to read through the substance of the question and not simply the use of the terminology. Okay. We also have what we call reconciliation, and this would, of course, involve agreeing two sets of independently maintained but related records. Perhaps in intermediate accounting, you are familiar with bank reconciliation, right? So in audit, we also perform reconciliation of records. Okay. And then analytical procedures, which we have mentioned a while back, okay, would of course consist of comparing relationships between data to determine reasonableness, again, working on the assumption that we expect some degree of predictability. Okay, so again, to reinforce vouching versus tracing, we always say that in a perfect world, whatever is in the records would have also appeared in the source documents. The records would represent the client records, and eventually this is what will go into the trial balance and the financial statements. The source documents here would refer to the actual existence or actual occurrence, okay, of a balance or a transaction. So in a perfect world, whatever's in the records would have also been in the source documents. But like what we have pointed out, the world is not perfect. And sometimes what is in the records cannot be found in the source document. Meaning to say, the client has recorded something that did not actually exist or did not actually happen. Can you imagine, for example, the presence of ghost employees, okay, or bloated purchases, or sales that did not actually happen? So they are included in the records, they are reflected in the trial balance and eventually in the FS, but they did not actually happen and they do not actually exist. So if you reflect on this one, it is found in the FS or in the records, but they are not there. That means the status of our records is that it is overstated. The records are overstated. It reflects something that does not actually exist. And in this case, when the status of the records is overstated, we get to ask the question, where do you start? Do you start from the records or do you start from the documents? And we get to realize that, hey, we cannot start from the documents. Why? Because there are no documents in the first place, right? You cannot start from the documents because the documents are absent. They are not there because they did not actually happen. And so, therefore, in this case, you should start from the records. And when we start from the records to the documents, this is what we technically call vouching. And the assertion we are testing here is existence. Now, some of my students use the mnemonic over to recall this one. O for overstatement, V for vouching, E for existence, and then R to start from the records. And then they just take the opposite when it comes to tracing. Okay, so that might be something useful for you to remember this as well. The mnemonic over. Okay, testing for overstatements means we have to vouch. We are testing for violations of existence, and we will start from the records over. Now, the reverse, but also in the contrary, it's also possible that they do not appear in the records, but they actually happen. So, this is the case of unrecorded transactions, unrecorded liabilities, for example. So, whenever we say unrecorded, that means the records are not complete. The records are kulang, no? The records are incomplete. And if the records are incomplete, then the records are understated. And as to the question of where should we start from, again, we reflect on the fact that, well, hey, there are no records. I cannot start from the records because there are no records. So we will start from the source documents. And this is what we technically call as tracing. And tracing will be a test for completeness. So here you will get to see that existence and completeness are actually opposing. No, they are opposite. They go in opposite directions. Whereas existence would be concerned about overstatements, completeness would be concerned about understatements. Whereas existence would mean we will start from the records, completeness would say would start from the source documents. Okay, so this is the difference between tracing and vouching. Well, I know for most of you, you already know this one, so I hope you didn't mind if we reviewed it again. Such an important concept. Now, here are other terms for audit procedures that you may come across when you look at an audit program or when you follow an audit program. You may see the term, for example, agree. So we normally say agree the scheduled balances to the general ledger. This is, of course, in answer to our audit objective of detailed tie-in, right? We may analyze account transactions, compare beginning balance with last year's audited figures. Of course, last year's ending balance should be this year's beginning balance, right? We count cash, we count inventory, we examine documents, we foot totals, right? We read minutes of directors' meetings, we reconcile cash balance, okay, balance per book and balance per bank, for example. We review disclosures, we review legal documents, and we scan for unusual items. So these are common terms that we use in reference to audit procedures. I'm pretty sure you might be encountering more than one of this when you later on work in external audit and see an audit program or maybe even make an audit program. Okay, so let's now give a summary of the procedures classified as to type and as to nature. Now, I always invoke the big three. The big three is IIO, inquire, inspect, observe, and I call them the big three because they are present in all three categories. Okay, inquiry, inspection, observation, they can be performed as part of risk assessment procedures, they can be performed as part of tests of controls, and they can be formed as part of substantive tests, whether RAP or FAP. You may perform the big three. Reperformance is reperforming a control activity. So therefore, that is called test of controls. Okay. When you are recalculating, you are reperforming the calculation. You are recalculating, then that's a different story, and that should be substantive test. Confirmation is a substantive test. Again, we'll talk a bit more about this in a few. Recalculation, as what we have mentioned, is also a substantive test. Analytical procedures may be risk assessment procedure if performed in the planning phase, and if performed in the testing phase, then they are also substantive tests. So you would notice of all of the procedures, only the big three has checked all three categories, right? So that's why I call them the big three. Now, let's talk about external confirmations. External confirmations, of course, encompass the process of obtaining and evaluating audit evidence through a representation or information of an existing condition, okay, directly from a third party in response to a request for information about a particular item affecting assertions in the FS or related disclosures. As what we have mentioned, this is a more formal level of inquiry where we request no for a written response. These are situations whereby external confirmation is ordinarily used, like for example, confirmation with bank balances and other information. We normally confirm as well accounts receivable. Okay. Then stocks held by third parties, property title deeds. We can also confirm investments that are still in the hands of the stockbrokers. We can also compare liabilities like loans payable and accounts payable. So these are just some of the situations where confirmations may come in handy. There are two general categories of the form of confirmation. There is what we call positive confirmation. And under positive confirmation, we ask the respondent to reply in all cases, whether the respondent agrees with the information or disagrees with the information. In all cases, we ask the respondents to reply. Whereas if we talk about negative confirmation, we only ask the respondent to reply if and only if the respondent disagrees with the information. Therefore, under negative confirmation, if we do not receive any response, then we would assume that the information is correct, right? With this, you will get to notice that there is a higher risk associated with using negative confirmation because we cannot just readily assume that a non response means everything is okay, right? What if the respondent did not receive the confirmation letter? What if the respondent received it but did not read it, right? What if the respondent does not exist at all? That's why the respondent didn't reply. So there are certain conditions where negative confirmation may be used, okay? Like, for example, when the assessed risk of material misstatement is low, or when there are a large number of small balances. You have accounts receivable, for example, totaling 1 million, but there are also 1 million customers in that accounts receivable. So, on the average, a peso per customer. So, a large number of small balances. Or a substantial number of errors is not expected. Or when you have no reason to believe that the respondents will disregard the request. So, when these conditions are met, if one or more of these conditions are met, then normally the auditor will go for negative confirmation. The usual format though, or form though, is a positive confirmation. There is also what we call a blank confirmation, blank, okay, meaning to say we do not provide the information, okay, we do not populate the letter with or the confirmation request with the information that we have at hand. We leave it blank and we ask the respondent to list down. Okay, for example, we normally use this one for banks. We ask the banks, for example, to list down all accounts that our client has with that bank and any relevant other information, such as if there are any liens or pledges and stuff like that. So that is what is called a blank confirmation. Positive and negative confirmation is generally used to test for the assertion of existence. Okay, that's really the usual assertion tested by confirmation existence. But notice if you use blank confirmation, a blank confirmation can even test for completeness. But as I've mentioned, we normally use this one with banks. We don't normally use blank confirmation with customers because I think you can imagine how you would feel if you are a customer and you receive a blank confirmation. It would just increase, instances of non-response. Okay, but it's there. Blank confirmation is a type of confirmation. Let's now reflect on some general points to remember when it comes to confirmation, such as, for example, have you ever wondered whose stationery or letterhead we will use when we write the confirmation request and who signs the confirmation request, right? So here are some general points to remember. Confirmation letter should be printed on the client's letterhead or the client's facsimile or email and signed by the client officer, not the auditor. Okay? Remember that in the case of AR, the customers of the client are not doing business with you. They are not doing business with the auditor. For all intents and purposes, they do not know the auditor. And so, therefore, it should be the client who will write the letter to them. Use the client stationery, use the client's facsimile or email, and then let the client sign it. The auditor should be very careful that the recipient's address is reliable and not subject to alteration by the client in such a way as to misdirect the confirmation. Okay, such as instances, for example, of failure of delivery, mainly because the addresses have been altered. So we should be cautious about that one. The request should seek information that the recipient can supply. So do not make it too overwhelming for the recipient. Okay? Ask for information that they can supply. For example, the amount of a balance or the amount specified in invoices or notes. The confirmation should be directly controlled by the audit firm, meaning to say, while the client signs the letter, the audit firm supervises the mailing of the said confirmation request. They should not be given to the client personnel for mailing because in that case, there's always the risk that they may not actually mail those confirmation requests to customers which they know will have disputed accounts or which they know do not actually exist, right? So the auditor should control the mailing and the responses should be returned directly to the audit firm, not to the client. Okay, so these are some general points to remember for confirmation request. Now, very quickly, let's look at analytical review procedures as well. So, particularly analytics performed in the testing phase. So, here are some factors to consider. For example, is it suitable to use substantive analytical procedures given the assertions? For example, if you wanted to test for the assertion of rights and obligations, I hardly think substantive analytics would be a good fit, right? So determine the suitability of using the substantive analytics. Second, consider the reliability of the data. And we have talked, in detail about the hierarchy of evidence reliability, right? So we consider the reliability of the data, whether they are internally generated or externally sourced, okay? And then from which the expectation of recorded amounts or ratios are developed. Later on, we get to see that when we perform substantive analytics, we develop an expectation. So we determine or we consider the reliability of the data that becomes the source of this expectation and, of course, the subsequent testing. Then we consider whether the expectation is sufficiently precise to identify a material misstatement at the desired level of assurance. Take note, it's an expectation, so it could never be accurate. That's why we're saying just sufficiently precise to give us that desired level of assurance. Okay. And then, of course, the amount of any difference of recorded amounts from expected values that is acceptable. In other words, we determine the threshold. Okay. So because later on, whatever would breach the threshold is what we will investigate. So, when more persuasive audit evidence is desired from substantive analytics, more predictable relationships are necessary to develop this expectation. Let's look at some, general rules of thumb when we talk about predictability of relationships. For example, relationships in stable environments are definitely usually more usually are usually more predictable than relationships in a dynamic or unstable environment. So, if you talk, for example, about an economy that is in turmoil, right? So, information or relationships may appear to be less predictable in those cases. So, relationships in stable environment usually more predictable. Also, relationships involving income statement accounts tend to be more predictable than balance sheet accounts. Why? If you can imagine the heading of an income statement, it says XYZ company income statement for the year ended, meaning to say, whatever happens or whatever is reflected in the income statement is only for a certain period, only from the start of the year to the end of the year. It will be quite easy for you to predict what happened within a year, right? As compared to a balance sheet, notice the header of the balance sheet. XYZ company statement of financial position for we don't you don't say for the year ended, you say as of December 31, 20 whatever. So if you can imagine, as of December 31, 2024, for example, that means from the time of the inception of the company until 2024. Imagine if the company was, if the company was organized or was given birth to as late as, not as late, as early as 1960. So that means from 1960 to 2024, that's quite a long period of time. And that's quite a lot of happenings. In Filipino, we say, in our slang, we say a lot of ganaps from 1960 to 2024, right? A lot of things must have happened within that period of time. So because of that, income statement accounts, which only cover one period, is more predictable than balance sheet accounts, which should be as of, no, a specific point in time. So there. And then, of course, relationships involving transactions subject to management discretion may be less predictable, such as, for example, estimates. Okay, so these are some of our general rules with regards predictability. Let's now look at the elements or steps when we use substantive analytical procedures. We start by developing an expectation of the recorded amount, and then we determine the amount of variation between the expectation and our threshold. If the difference is material, we make inquiries of management. So investigation of variations that cannot be accepted without explanation. If we cannot get the explanation or the evidence is not adequate, then consider conducting other audit procedures. However, let me point out to you that when we use analytics as substantive test, okay, like what we have said, we develop expectations about the FS, we compare the FS with the expectations developed. Is the difference significant? No. If not, we accept the account as reasonable. Meaning to say, not all differences will be investigated. That's why it's important for us to develop the threshold. Okay, so if the difference breaches the threshold, then we conduct further investigation. Okay, allow me to backtrack a bit also by saying that before we develop any expectation or compare the FS, etc., as per usual, we of course have to first understand. Okay, we first have to understand how management came up with the estimate, how management came up, for example, no, with these particular information in the FS. That's a given, right? And then we understand the industry, we understand the environment, we understand the entity. Okay, those levels of understanding, that GTKY, will lead us to our expectations. All right, so there. That will be using analytics. Here are some of the ratios commonly used. Now, this is, I know, management services topic, but let's just very quickly run through some of the ratios and what could be its audit significance. For example, one of your favorite ratios of all time, current ratio. Okay, the audit significance of the current ratio is that if you have ever noticed a significant increase in the current ratio compared to last year, it may indicate a completeness problem. Okay? It may indicate. However, it may also be influenced by changes in asset accounts. So, therefore, while we are aware of the possibility that the completeness assertion may have been violated, that is why there's a significant increase or movement in the current ratio, we also acknowledge that there may be valid reasons. That's why we have to investigate. Another favorite ratio used in substantive analytics is the accounts payable turn days. Okay, so prior experience in account payable turn days, or the turn days, no, for accounts payable, combined with the knowledge of current purchases, can be used in estimating current payables. A shortening of this period may indicate completeness problems for the audit side as well. Okay, but again, there may be valid reasons why the ratios are changing. Another is inventory growth to cost of sales growth. So if we have found ratios larger than one, it may indicate that inventories are growing faster than sales. The business is amassing more inventories than they can sell, right? Large ratios may also indicate possible inventory obsolescence problems because it would seem like the company is not able to sell, okay, their inventories as quickly as we would have expected them. In case of fixed asset turnover, an unexpected increase in fixed asset turnover may indicate the failure to record or capitalize depreciable assets. Okay, for in the case of free cash flow, negative free cash flows indicate the need for expected financing. It might mean that the company might look into debt financing, okay, in the future, drawing down on cash investments. So there are implications to the ratios that we have seen. So in the case of audit, we are not super concerned with the formulae. Of course, we need the formulae to come up with the correct ratios, but we are giving more emphasis on its audit significance. Okay. And then lastly, let's very quickly talk about auditing rather accounting estimates. We know that estimates carry with them a certain level of inherent risk. So it's an approximation of an amount or item in the absence of a precise means of measurement. And it is this approximation that makes it vulnerable to risks. Here are some examples of estimates. I'm sure you have met them at one point in time. Allowance for doubtful accounts, allowance for inventory obsolescence, your favorite depreciation, accruals, okay, in the case of deferred taxes, provisions for losses, and losses in construction contracts, and even provisions to meet warranty claims. So these are just some of the many estimates that we will encounter in an audit of financial statements. So what are the procedures to test accounting estimates? Similar to everything else, we of course always start by an understanding of how management comes up with these estimates, and then we test the process used by management to develop the estimate. We develop our independent expectation, and then we review subsequent events or transactions. So notice that just like analytical procedures, we also develop an expectation for the estimates, right? So in this case, however, we start by testing management's process, then developing our independent expectation. We could also review subsequent events or transactions, such as, for example, if you can reflect on scrap value or salvage value being the estimated value of the asset at the end of its useful life, right? Meaning to say, if you're going to take that imagination a bit further, if that's the estimated value of the asset at the end of its useful life, then if you're able to sell the asset at the end of its useful life, the proceeds should be the same as the salvage value, right? In a perfect world. And so, therefore, one way of testing the estimates is to look at the subsequent event. You look at an actual sale of an asset that has reached the end of its useful life, and then compare the proceeds with the salvage value. Or if you talk about accruals, for example, accrued expenses like accrued utilities. Okay, in order to test that, you could always look at the subsequent actual payment of the utilities that were accrued. Okay, so that is what we mean by review subsequent events or transactions. All right, so that's it for audit procedures. When we come back, it will be all about audit evidence and documentation, which will neatly seal off this installment series. So I mean this lecture series on audit objectives, procedures, evidence, and documentation. So I hope to see you in the next video to talk about audit evidence and documentation.